Welcome to Principles of Costing. Principles of Costing is one of the 3 units that we cover in Certified Accounting Technician Stage 1. In Stage 1, we have 3 papers. Number 1, S1.1 Recording Financial Transactions, S1.2 Principles of Costings, and S1.3 Effective Working in Accounting and Finance. For our principle of costing, which is our subject today, Principles of Costing has a total of 6 topics or 6 units. Topic number 1, Introduction to Cost Accounting. Topic number 2, Cost Classification. Topic number 3, Cost Behavior. Topic number 4, Material Costs. Topic number 5, Labor Costs. And the last topic in Principles of Costing is Comparison of Costs and Income. Now, in Introduction to Cost Accounting, which is our topic number 1, we are going to cover the following subtopics. Subtopic number 1, Introduction to Cost Accounting. Subtopic number 2, Types of Business. Subtopic number 3, Types of Transactions. Subtopic number 4, Types of Industries. We will also look at types of accounting systems, purpose of accounting, difference between financial accounting and cost accounting, and finally, we'll look at what is called accounting information. When we start with subtopic number 1, which is what is a business, under our introduction. Business has got 4 definitions that we'll be focusing on today. The first definition, a business is a commercial or industrial concern which exists to deal with manufacture, resale, or supply of goods and services. The second definition, a business is an organization which uses economic resources to create goods or services which customers will buy. In our third definition, a business is an organization providing jobs for people. And our last definition, a business invests money in resources in order to make even more money for its own owners. Examples of resources includes buildings, machineries, and employees. In our next item, the last definition of a business, it focuses on making a profit. So whichever type of a business, whether it's a small business, like maybe a sole trader who is operating in Nyabugogo, or a larger business like MTN, Bank of Kigali, or even Crystal Ventures, whether it's big or small business, the objective is to make a profit. When do we have a profit? Profit arises when the revenue from the business or the income from the business is more than the costs. When the costs or expenditure are more than the income, we have a loss. The second item in our topic number 1 is types of businesses. From our previous studies, we know that we have 3 types of businesses. The first business is a sole trader, the second business is a partnership, and the third business is a limited liability form of companies. In a sole trader, we know that a sole trader is a business that is owned by one person, but that person can employ 1 or 2 employees, can have 1 or 2 employees. The key point is it's a business owned by one person. The business affairs or the individual's business and personal affairs, and for legal and tax purposes, are identical. So a sole trader is a business owned by one person. The second form of business is a partnership. In a partnership, there is an arrangement between two or more individuals to carry on a business with the objective of making a profit. A partnership involves obligation to others. Because there is obligation to others, there should be what we call a partnership agreement. On the other hand, we have a limited liability. In a limited liability arrangement, the status means that the business debts and personal debts of the business owners are separate. So the individual's debts and the debts of the business are separate. The shareholders cannot be sued for the debts of the business because they are separate. So the debts of the business and the individual's debts are separate. Our third item is types of transactions. We have 5 types of business transactions. The first type of business transaction is sales or sale of goods. The second transaction is purchase or purchase of goods. The third transaction is paying expenses. Our fourth transaction is paying employees. And the last transaction is purchasing non-current assets. In our next area, we need to distinguish between different forms of business transactions. And there are 2 major transactions we are going to distinguish. The first one is the difference between cash and credit transactions. And the second one is the difference between what we call capital and revenue expenditure. Let's start with cash and credit transaction. In a cash and credit transaction, the difference is the timing of payment of the transactions. In a cash transaction, the payment is made immediately. Whether it is through cash or through a check, the payment is immediate. While on the other hand, in a credit transaction, the payment is not immediate. The payment is at a future date. So the difference between cash and credit is the timing of the payment. On the other hand, when we come to capital and revenue expenditure, capital expenditure is expenditure on acquisition of non-current assets or improvement on the capacity of the non-current asset. Capital expenditure is expenditure to acquire or purchase a non-current asset or to improve the earning capacity of the non-current asset. On the other hand, revenue expenditure involves expenses incurred in the daily operating activities of the business. So revenue is on the daily operating activities of the business. Revenue expenditure are expenditures on a regular basis. In our next item, after looking at cash and credit transactions and capital, we need to look at what is the difference between capital expenditure and revenue expenditure. There are 5 differences we are going to focus on. The first difference, under capital expenditure, the expenditure is incurred to acquire non-current assets. And these assets should not be resold. They are not meant for resale. On the other hand, on revenue expenditure, it is expenditure on a routine basis. Expenditure that we incur on a daily basis. The second difference between capital and revenue expenditure, capital expenditure increases the earning capacity. The third difference, in capital expenditure, it is a non-recurring expenditure. It is expenditure incurred only once, while a revenue expenditure is a recurring expenditure, expenditure incurred routinely or regularly. The fourth difference, capital expenditure produces benefits over a number of years. In other words, capital expenditure are long-term. On the other hand, revenue expenditure, it is consumed within a year. It is only spent within 12 months. The last difference, on capital expenditure, it is an item that goes to the statement of financial position, while revenue expenditure is an item that goes to the P&L, profit or loss account. Let's now focus on types of industries. Remember, we are laying the background on principles of costing. We have three types of industries. Number one, we have what we call manufacturing industry. Number two, retailing industry or organizations. And number three, service industry or organizations. When we start with manufacturing organizations, these are organizations that convert raw materials into finished goods. Number two, retailing organizations. Retailing organizations sells finished products to final consumers. They don't manufacture, they don't produce. On the other hand, service organizations, their outputs are intangible and they do not hold inventory. So that is types of industries. In our next item, we are looking at what we call types of accounting systems. Now, under types of accounting systems, we have two types of systems. The first system is an integrated system, and the second system is interlocking system. In accounting, accounting is basically divided into two: cost accounting and financial accounting. Principles of costing is under cost accounting, and recording financial transactions is under financial accounting. Now, in an integrated system, it's a system that combines both the cost accounting and financial accounting into one system. So an integrated system is a system that combines cost accounting and financial accounting functions in one system. And this helps to save on costs and time. On the other hand, interlocking system is a system where the cost accounting function and the financial accounting functions are separate. They are different. In our next type of system, topic or subtopic is purpose of accounting. Why do we need accounts? What is the purpose of preparation of accounts? There are four major reasons why we prepare accounts. The first reason is to show financial performance of the business. Financial performance is shown through preparation of statement of profit or loss. The first purpose is to show financial performance. On the other hand, the second purpose is to show financial position. Financial position purpose is shown by preparing a balance sheet, what is known as statement of financial position. The third purpose is to show changes in financial position by preparing a statement known as statement of changes in equity. And the last reason for preparing accounts is to show the cash position of the business through statement of cash flow. In our next area, we are now focusing on what are the differences between financial accounts and cost accounts. Cost accounts are also known as management accounts. So the difference between management accounts and financial accounts. There are 6 differences we are going to focus on. The first difference is on the information users. Management accounts are for internal users like employees and managers, while financial accounts are for external users like shareholders, creditors, lenders, banks, or even government. The second difference is on purpose of preparing the accounts. There are 3 purposes for preparing management accounts. The first purpose is to help in planning. The second purpose is to help in control. And the last purpose is to help in decision making. On the other hand, on financial accounting, there are two major purposes, although we had previously listed 4 purposes. The 2 major purposes are to show financial performance and to show financial position. The third difference between management accounts and financial accounts is legal requirements. There is no legal requirement for preparing management accounts. On the other hand, all limited companies must prepare financial accounts. Then the fourth difference is on the format of the accounts. Under management accounting, it's upon the management of the business to come up with the format of management accounts. On the other hand, it's what we call accounting standards. They give the format of financial accounts. The fifth difference is on the nature of the information. Under management accounts are financial and non-financial in nature, while financial accounts are purely or financial. The last difference is on time. Management accounts are both historical and future-looking. In other words, management accounts are for the past and also for the future, while financial accounts are purely financial. Let's now focus on principles of costing. Remember, costs, they are calculated to help in decision making. When you are making a decision, you need what we call information in order to make a decision or to take a decision. So we need to look at what is the difference between data and information. In order to have information, you need what we call data. Data are raw facts and figures before they have been processed. Or data are facts and figures that are unprocessed. On the other hand, information is data that has been processed. When we process data, it changes into information. When we look at types of data, there are 3 major types of data. Number 1, we have what we call primary and secondary data. Number 2, we have what we call discrete and continuous data. And number 3, we have what we call internal and external data. When we start with number 1, primary and secondary data. Primary data is data that has been collected for a specific purpose. So we collect that data for only this reason we are going to use it for a specific purpose. On the other hand, secondary data is data that was collected for another purpose, but we are now using it for our decisions. That is secondary data. The second type of data is what we call discrete and continuous. Here we need to be attentive because there is a small difference between the 2 forms of data. Under discrete data, this is data that can be counted. This is data that is finite. Finite is something with an end. So data that can be counted, is an example of it is the number of goals that can be scored by a team. A team can have 0 scores, 1 score, 2 score, 3 scores, or even 4 scores. So that's discrete. Discrete is something with an end. On the other hand, continuous data is data that somebody's height can be 1.2 meters, 1.25 meters, or even 1.3. The key word is it's point something. It's something without an end. While in the other case, we were having discrete, something with an end. The last form of data is what we call internal and external data. Under internal data is data that is collected from our own records within the business. Internal means within the business, from our own records. For example, accounting records and data relating to staff or personnel are examples of internal data. On the other hand, external data is data collected from outside the business, from elsewhere. For example, we can collect it from the internet, government statistics, or even financial newspapers. Next, we need to focus on this information that we have defined as processed data. Data that has been processed. This information should have certain characteristics or certain qualities. So let's focus on qualities of this information. Under this information, the first characteristic of a good information, it should be accurate. Information is accurate if it is precise, if it gives what we need. Information, number 2, should be complete. Information is complete if it gives us all that we need. Users should be provided with all the information necessary to make what? Decisions for the information to be complete. The third characteristic, information should be cost effective. Cost effective means the benefits you get from the information is more than the benefits the benefits you generate from information is more than what you spend to collect the information. The next characteristic or quality, information should be understandable. That is, the receiver of the information should be in a position to understand what the information is telling him. Next, information should be relevant. Information is relevant if it is important. The information must be relevant to the needs of the users. Information should also be attainable. Information should be based on what is within the ability of the users to achieve. Information should be time-bound. In other words, information should be provided before a decision is made. And finally, information should be easy to use. So there is a certain acronym we use for these qualities of good information. The acronym is information should be accurate, where letter A stands for accurate, the first C stands for complete, the second C stands for cost effective, U stands for understandable, R stands for relevant, A stands for attainable, T stands for time-bound, and E stands for easy to use. So information should be accurate. Role and functions of a manager as we wind up on this chapter. A manager can have many roles. These roles or functions are normally setting objectives to be achieved in the future. Number 2, making plans on how to achieve the objectives. The third function is putting plans into action, monitoring actual results and taking control measures and make adjustments where necessary, and finally, evaluating actual performance. These roles are summarized into 3: planning, control, and decision making. So what is planning? Setting goals to be achieved in the future. These plans are at 3 different levels: strategic plans, tactical plans, and operational plans. Strategic plans are long-term, set by the top management, and they affect the whole organization. Tactical plan, on the other hand, they are middle-term, set by middle-level management, and they run for a period up to 1 year. And operational plans, they affect the day-to-day activities of the business. Next, we are going to control. Control involves comparison of actual results to the plan to get the difference and investigate the cause of the difference. And lastly, we have what we call decision making. Decision making involves making a choice, having alternatives, and making the best choice. So that is basically the 3 roles of a manager. Finally, in our last item, we are looking at purpose and role of cost and management accounting, and we have 8 purposes of role of cost and management accounting. Number one, it helps to allocate resources of the business. Number two, it helps in performance evaluation. It helps in motivation of employees. Number four, it helps in communication of the targets of the business. It helps in accounting for the costs incurred. It helps in planning and budgeting. It helps in control of operations of the enterprise. And finally, it helps in decision making. In conclusion, what have we looked at? What are the types of businesses? What are types of transactions? What are the types of accounting systems? What is the managerial process of planning, control, and decision making? What are the difference between management accounting and cost accounting? And finally, what is the purpose of cost and management accounting? And this brings us to the end of Unit 1, Introduction to Cost Accounting. We will meet in our second unit, which will be cost classification. Thank you for your time.